I've taken over 3,000 trades using this one particular strategy. And this strategy has gotten me an 81% win rate and making 20% returns monthly. And it's also one of the main strategies I teach my students in my academy that we use every single morning in our live trading room. And yes, they also have an 81% win rate with 21% returns monthly. My name is Nestor. I'm the owner of FinTrade Master Academy, where we teach people how to trade like the banks and make 20% returns monthly. I'm going to break down this strategy for free, step by step, to the point where you can start implementing it in your trading tomorrow. Let's dive in. So before we just dive into, the charts and everything else like that, and basically just diving headfirst into the charts, I want to explain what is supply and demand, giving you like the official definition, and then breaking it down so you can understand it, and then breaking down what is supply, how to identify supply, what is demand, and how to identify demand. And then we'll take what we just learned and put it into the charts so that way we can actually implement this literally once we finish watching the video. Cool. One thing I like to let people know is that this is not scripted. Of course, I have a flow chart that I made prior to, but this is not scripted because I actually do this. I actually really do the results. I actually make what I say I make, right? I'm not one of those fake gurus with the Lamborghini and, flaunting diamond chains and all that other bullshit, right? I'm someone that's real that actually does that. If anything, the gurus that you probably follow take this information from me and then regurgitate it into their Instagrams. They're just better marketers than I am, is all it is, right? Cool. So let's dive in. So, what is supply and demand? Supply and demand is price action strategy that identifies specific chart zones where large institutional orders, buying for demand, selling for supply, are concentrated. These areas cause significant price imbalances, marking key support resistance levels where traders expect price reversals. That's like the fancy definition. What does it mean in plain English? Essentially means price, as certain areas have big banks that step in that drive price in a very harsh manner in one direction. So you probably have seen somewhere on charts, kind of going up, down, up, down, and then all the way up and then all the way back down, right? That means there's probably a demand zone at each of these lows, potentially, right? And then the harsher the move to the upside, the likelihood of there's a demand at the bottom and then a supply at the top, which I can break down on the charts, right? So essentially stating that when price moves very harsh in one direction, it's causing a lot of orders to still be filled. So what does that mean? That means supply and demand zones are magnets for price. It's always going to gravitate back towards the nearest supply or the demand, and that's just how price moves. That's what moves the market. That's what supply and demand is. None of this other BS stuff that you hear on the internet. Supply and demand is literally the fundamentals of trading. And then you have all your other fancy things that people like to throw in there. Supply and demand, if you understand this first, you will make so much more money than you could possibly imagine, right? So let's talk about what is supply and what is demand. So let's talk about supply. Supply is an area where selling interest is high, often leading to a price drop, allowing traders to sell short. So, what does that mean? That essentially means we are looking for sells, right? So, the way I remember this is supply S for sells, right? Very easy. But the thing is this is you're probably wondering, well, how do I actually identify this? I get supply, we're looking for shorts, and we're probably gonna, sell off and have a big retracement and come all the way down. But how do I figure out what is a supply zone? Well, this is the formation of the candles. You have a bullish candle followed by three bearish candles, right? So we write that. We say that one more time, and you should be writing this down. Have like a pen and paper with you. The formation is a bullish candle, one bullish candle followed by three bearish candles, right? So then we go over and we talk about demand now. Demand is just the opposite, an area where buying interest is high, often leading to price increase, allowing traders to buy, which is long. So we're taking buys, right? Price came down for us to take buys. What's the formation? It's just the opposite of a supply zone. Bearish candle followed by three bullish candles. One more time. Bearish candle followed by three bullish candles, right? Now on the charts, we're going to take this same exact thing and we're going to talk about how to find these, how to identify these, how to spot these, as well as what makes an A plus versus a B plus and versus just don't touch it, right? Let's kind of go into that right now. So I'm going to pull up a chart of US 30, right? So you can find supply and demand zones on any time frame, 4 hour, 1 hour, 30 minute, 15, 5 minute, 1 minute, right? Personally, it's always good to, if you're going to be like a scalper, stay on the 15 minute. If you're going to be like a day trader, and you're probably going to hold trades or swing trade, 30 minute to 1 hour, right? But 15 minute is usually a good time frame. So I'm just going to go back into time. I'm going to go back into where price was like super choppy. Let's say like right here, right? So I have no idea where there is supply or demand. Actually, I currently see one here on the 4 hour, which I'll actually highlight for you right now. So let's talk about this. Now, again, we're going to go down on the different time frames, but I just want you to get the idea of what is supply, what is demand. So right here, you have a nice demand zone, right? A nice demand zone that it tapped into and then went straight up, right? So you could have taken this buy on the 4 hour and gone up. Now, here's the thing. This is the formation. Bearish candle followed by 3 consecutive bullish candles, right? Now I'm sure you see this one right over here. You're like, wait, this is also a demand, but why is the zone different, right? And then it taps right into here, and then look what it does. Just freaking fires off, right? Just continues all the way up, and it just really goes. So what makes this one so good and this one so less, right? Why did this one tap in and then it just flew versus this one it just moved a smidge compared, right? And why is my zone like this versus like this, right? So this is where we're going to talk about what's a good setup, what's not a good setup. So essentially, there's two. I call me. This is like me personally putting my own like verbiage to it. This is not exactly what it's called. This is just me using my own verbiage, right? So essentially speaking, there's going to be easy zones, which are usually high probability, and then there's going to be hard zones, which are usually low probability, right? So what makes a hard zone? A hard zone is when you have this, right? So ideally, what you want to do is you want to draw the zone from wick to wick of the red candle, right? That's essentially what you want to do. Draw the zone from wick to wick of the red candle. But if you see a bullish candle that has this little wick at the bottom, include that into your zone. But the thing is that makes that zone even much bigger, which makes it more complicated. So what does that mean? That means if price taps into this, you're going to have a big stop loss, a very, 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 very big stop loss, right? So, because the stop loss will be all the way down here, because the stop loss you put is at the bottom of the zone, right? So when we're entering into the zone, which I'm going to talk about confirmations of how to enter, right, later on, we enter into the zone, we take our buys or sells, we put it, if it's a buy, we put it at the bottom of the zone. If it's a sell, we put it at the top of the zone, right? So you can already see this is a massive zone. This is essentially, we put a ruler here, like a big zone, as you can clearly see, 532 points, right? But if we go over here and measure this zone, it's literally half of it. Right? So their stop loss is going to be a lot smaller. So this is a higher probability and a lot easier zone to know that this is going to tap into and then go up, right? And notice this is that it drew price back down here and then it drew price back down here again. These are magnets, right? Price like supply and demand zones are magnets always, right? Now we found demands. Now let's talk about supply, right? Supply is right here. We have a bullish candle followed by 3 consecutive bearish candles, right? Now, here's the thing with this. We have wick to wick, same way we did the first time, wick to wick, but this is time it's on the bullish candle. Why? Because with a supply zone, it's a bullish candle followed by 3 consecutive bearish candles, right? So we're going to draw the zone from wick to wick. Now, essentially, what we're waiting for is price to come into our zone to then continue for sells, right? I don't know if it does that or not, but I'm not going to play it out because uh, I don't feel like doing that right now, right? So essentially, we're waiting for price to come up tap into our zone, and then sell off and come down, right? We also have a demand zone. Now the demand zone already got tapped into, right? So it's basically saying, and it's respecting this whole area as well. So essentially saying that this may come up into the supply to come down for sells, right? So now we have identified a supply zone. Now this is a high probability supply zone. Why is it high probability? That's an easy zone to map out, right? That's one of the indicating factors of a high probability zone. Right? There's a lot of other indicating factors, but this is the main one. Not the main one, but this is one of the biggest ones, right? The second indicating factor is market structure. How many levels of market structure were broken? What is market structure? Market structure is essentially a series of highs and lows, right? So we have a low, we have a high, we have a low, we have a high, and then all of a sudden we have a low that passes the previous low. So now we're going down. We have a high that passes that's below the previous high, and then it continues to do that, so on and so on, right? Creating market structure. So let me kind of just map this out, right? So we have a high here, and then we have a low here, and then we have essentially, yeah, we can even put this here, right? So essentially we have our highs and we have our lows. And then we also have another one right here. Boom. Cool. So I actually will get rid of, I'll leave that one. I'll get rid of this one actually. Yeah, so we have three different levels, right? Price does what? Price breaks above 1 and 2 and then comes back down, does not tap into it, creating a what? A higher low, right? And then goes back up, breaks past this not resistance, breaks back this market structure again, 1, 2, and then comes straight down, taps into this and goes up. So what does that mean? That means it broke levels of market structure to confirm that this wants to go where? Up, not down, up. Now it just has to tap into this demand zone to collect orders for us to officially go up, right? That's all it's got to do. Now let's go down to the 15-minute and let's actually see this on the 15-minute, right? So we can actually talk about entries and whatnot. So go down to the 15-minute, right? Again, I don't know what price is doing right now, so let's just kind of go in the BAST right here. Boom. This is actually a very good setup. So we have a nice supply zone right here, right? Now, why am I including this green candle here? Because sometimes you can piggyback off of one another. This is kind of a uh, your own judgment, right? Because what's the reality of price tapping into here versus here, right? It's a lot higher probability that price is going to tap into this zone here. And then the thing is, your stop loss is already above this zone. You could be cautious and put it above these wicks if you like to, play with it, but your stop loss is going to be above the zone anyway. So just be safe rather than sorry, right? Make the zone a little bit bigger, protect, cross your T's, out your I's, and then let's see how it plays out, right? And then we just drag this all the way out, right? Which, funny enough, this is, why is it doing that? Funny enough, this is actually the same supply zone that we saw in the 4-hour. If I map that out, oh, it's not. It's actually relatively smaller. My fault. So this is actually a supply zone here. Now, does this go all the way up? No idea, right? I don't know if this goes all the way up. But we also see what another supply zone right here. Literally, taps into that and rejects and comes all the way down, right? So this is where we can start identifying our supply and demand zones. Now, which one of these is a high probability? Both of them are. Why? Because we have series of market structure being broken. We have a high, we have a low, we have a low, we have a high, we have a low, we have a high, we have a low. So we're clearly coming down, right? So we have a level here, and then we have a level here, and then we have a level here, right? And it just completely broke all these levels. So that means this is a high probability, and so is this. So that meant if price did push above this zone, expect it to sell off here, but price stopped in this zone. So that means this is a good entry to take, right? So let's kind of delete these. So again, just to recap, what's the first sign of a good supply or demand zone is how easy the zone is to draw. You saw two examples. You saw a zone where it's just wick to wick of the actual candle. If it's a supply, green to green wick. If it's a demand, red to red wick. But you also saw where you saw that candle, right? And then you saw that extra wick down here. Those aren't high probability zones. Still, you can map them out just in case, but they're not high probability zones, right? So that's number one. Number two is what? Market structure. Market structure having series of levels being broken by price, driving it down, and then retracing to confirm that we want to go up, right? That's essentially what is causing this to be an A plus setup so far. Now, another thing that causes this to be an A plus setup is the distance between where price is at and where the supply zone is at, right? So basically, if I were to replay this even further, let's go here, right? Is this 9:30? Yeah. So this is essentially 9:30 right now, right? This is 9:30, and you could probably look at this and you'd probably be like, wait, this could be a demand zone. No. Oh, wait, this could be a demand zone. No, it's not. Don't just because you see a bearish candle fall by three consecutive bullish candles does not make it a demand zone. So so just be cautious on that, right? You need to have it be the last pair. So it should look so this right here does not count. Why? Because it doesn't have any market structure breaking. It just stayed in this area. So essentially it would be something like this if this was a valid demand zone, but it's not. It's not a demand zone, right? So and then here, what you're probably seeing is like, oh, I see a supply zone right here. But what did we just say? We said that this is a low probability supply zone. You could even make the zone down to here if you wanted to, or even down to here. This is a low probability supply zone. Very, very, very low probability, right? So not very good supply zone there. So now you're starting to see the difference between a high probability and a low probability supply zone, right? Now let's see if there's any demand zones. Nope, no demand zones down here relative to price. Cool. So now we're going to talk about demand zones here in a second. We're just focusing on supply because that's what we see right here, right? So now we're going to talk about entering, right? So I'm just going to play this. Let's go down to the 5 minute, right? And on the 5 minute, you could be like, well, Nestor, there's a demand zone right here. No, look at how massive this damn candle is, right? And then on top of that, like you have this candle here, it's not consecutive, right? And then if you say you want this to be a demand zone, well, think again because it's not really at the bottom. Think about it this way, the closer to the bottom it is, the better, right? This is not a demand zone. This is just literally just some small pullback to continue upwards, right? So that's not a demand zone at all. So let's continue playing this. Now this supply zone looks pretty good on the 5 minute, right? On the 5 minute, this supply zone looks pretty good. That price could gravitate towards, and we could take a selling position, right? But let's just play it out, market open, but in 5 minutes here, play one candle at a time, see what happens. All right, see, this is why it's not a demand zone. Look at that thing just like disrespected that in like a second, right? So let's play it one more time. Let's keep playing this until it shows us where it wants to go. See, it's rejecting to the downside a lot. It's rejecting and comes up. Remember, these are three different levels here. So you have a 5, 15, and 15, right? Now, one thing to note, the higher the time frame, the stronger it is. Now, this could be a higher probability setup, but it's on a lower time frame. Higher the time frame, the stronger it is. So let's continue playing. All right, now it's starting to go up. Boom. It actually just literally disrespected this whole entire zone here. That's why I say higher the time frame, the better it is. Now, how do I know when to take this zone, right? How do I know when to get in? This is where I'm going to show you price action, right? Now, obviously, we're not going to go down. We're not going down to the 1 minute for our entries. We want to take it on the 5 or the 15, right? Around those two areas, right? Now there's two types of entries. If you were to take this entry right here, This would be called an aggressive entry. Number one, I'm just going to label it A. Aggressive entry. Why is that considered an aggressive entry? Because you would put your stop loss right at the wick, take your sell wherever you see the rejection. So let's say it stopped here and then you started seeing rejecting here. You take that selling position, but your stop loss is at the top of this wick. And then you would target the low down here somewhere, right? That's essentially an aggressive entry. Now, do I like aggressive entries? No, not necessarily, because I'm somebody that likes to preserve capital. I don't like to, as they call it, just risk the biscuit. I really want to protect my capital. Now, would I take a sell on this? Potentially, because we have a massive rejection on the 5 and we have a massive rejection on the 15 as well. And it just tapped into it perfectly. So I probably would be looking to take a sell as I'm starting this to see reverse down, right? I probably would, to be quite honest, with the size of this candle, I would just want this to pull back a slight bit to then come back down, right? I don't know if that happens or not, but we'll see. So that's one. Let's repeat that. Number one, aggressive entry, right? I'm just going to label it A. Aggressive entry is when price touches this zone and leaves, doesn't have to close. It doesn't have to close. It just starts to reject harshly. You can take a sell or take an entry, depending if it's supply or demand, and you're going to put your stop loss right at the top of that wick. Now, why are we putting at the top of the wick? Is because the wick is essentially saying, I tried to go here, but failed to go through, so I'm coming back down. That's essentially what the wick is saying. Or I try to go down, but I can't go down, and so I'm going up. So it's basically saying that if I come back down to this area and I push past where I tried previously, I'm going to continue in that direction. The likelihood of me continuing in that direction is a lot higher. So that's why you put it at the top of the wick, okay? Now, when we're looking for the second type of entry is called a confirmation entry. So number two, I'm going to label it as C for confirmation. Now, how do we identify what a confirmation entry is? I'm going to do this on the 1 minute so that way you can see the formation of candles because we did not have it here, right? It'll take me forever to find it on the chart. But I'm just going to show you on the 1 minute for the formation of candles. Let's take a look here. So boom. So we have the first candle come up here, right? Fantastic. But the thing is the candle started down here. That's not that great of a sign. So now we need to wait for two 5 minute candles. Why is that? Well, one, we need to wait to see if this, respects. And second, we need a candle closure. And then we need the next candle to pass the previous wick right here. And then that's when we can get into our selling position and our stop loss will be above the zone here. So what do I mean by that? So meaning this candle closed, right? Oh, damn it. So let's actually make the bar back here on the 1 minute. Boom. So let's do the replay. Play 1 minute. All right, cool. So we have this candle, right? This candle closed, and we don't know what that next candle is going to do. This next candle could just come up, right? We don't know yet. So we need a confirmation. So what's the confirmation is we need the next candle to push below this zone, not the zone, for this below this wick for us to take the selling position. So meaning if it's going to open up right here, it could leave a top wick and then come down. And then the moment it crosses this wick here, we take a selling position to the downside and we target this low here. Okay, so let's actually play the next candle out. Boom, it does exactly that. Now, I'm just going to take the sell, pretend that I took the sell right there. It's going to sell it. I don't know, let's just put 10 suckers on this. Sell, stop loss above the zone, and then take profit down here, right? So essentially, it's a little over a one to like one and a half potentially that we're targeting, right? And we confirm we're in the trade, right? Now we just play it out. Just keep playing it, letting it play out. All right, this is, oh, well, actually, on this candle, I try to press pauses. On this candle, I probably would have gone break even stop loss and have closed half of my position, right? That's what I would have done, but the next candle just printed. So it is what it is, right? But on this candle, I would have gone break even stop loss, taken half profit, and called it a day, right? And then just played out the rest of it, which I would have gotten stopped out at this point if I went break even stop loss. I think this is going to hit stop loss now because I think this does go up if I remember correctly, or just consolidates for the rest of the time. But point I'm making is that that's how you do the entry, right? Now here's the thing: I would have closed half of my position here, wherever. Let's replay that, right? I'm just going to close, make one little boom, boom, right? Actually, let's play. Let me go back in time here, so we can actually make this very much realistic. Selling position, sell, stop loss here, take profit here, right, and then play it out. Hopefully, I can catch it this time. Wait, I gotta confirm this bad boy, and then I think it's gonna. The moment it passes, boom. Is it the next one? Yeah, this one, right? So now here, what I would do is I'm at a 1-to-1. Honestly speaking, I would honestly just close half, right? Close half, move my stops to break even. So I would have made some money, confirm, got it, confirm, and then call it a day, right? I would have closed half of my position and made what, $1,000, and then left the day, go live my life, and we would have won, right? And this is how we make our 81% win rate and make 20% returns monthly. It's like clockwork. We're closing half of our position, checking off the W, and then letting the rest ride and do whatever it's going to do. We made money, right? And then that's it. And then the next thing you know, it pops up and then it stops me out, right? And then boom, right there, right? Stopped out. And that's how that works, right? If this is making sense and this is clicking, right, and you're liking the way I'm explaining things, then we do have a done with you concierge model. If you just come to the link down below in the chat, in the description, you can watch this video. You can click the apply now button to learn more about how we can help you out and make 20% returns monthly as well. All right, now back to the video. So let's dive back into US 30 here. Now let's go into demand, right? Let's go into demand zones because we just did supply. Now let's talk about lovely old demand zones. Let's see if we can find one. Um, they're kind of hard sometimes on US 30. Let's go to NASDAQ. NASDAQ's a lot easier to find demand zones since all right, let's see if we can find a demand zone. So we have some there. All right, nope, nothing there. Nope, nothing there. Uh, so this is a low probability. Yeah, that's not going to count. That's not a good one. Demand zones are a bit tougher to find. Um, let's keep on finding. We're not going to give up. Oh, wait, did I just find one? Yep, found one. This is a lovely demand zone. Look at this. And look at that. Wick to wick, 3 consecutive candles. We have what? Market structure broken here, market structure broken here, market structure broken here, and it just continues to break market structure. And guess what it does? It comes all the way down back into our demand zone. And this is actually perfect because it actually does a what? Confirmation entry. This is perfect, right? So what happens? Well, first of all, let's break down why this is a demand zone. Bearish candle followed by 3 consecutive bullish candles. Why is this high probability? It's an easy zone to create, wick to wick, right? Red wick to red wick. And you have a level of structure broken 1, 2, 3, 4, and it just continues to break market structure. For me, 3 is good. 3 is like top tier, A plus. This thing's gonna come back, tap this, and then just sky to the moon, right? 2, yeah, pretty good. 1, very low probability, right? So that's why the other one I said is not that great of a good demand, right? So this one is very prime and very good. And if you notice, it's a magnet, right? It just came straight down, and it was a magnet, just basically absorbed price back into this area to collect orders. Now, if you do this correctly, right, this could be an easy 1 to 1.5. So if you risk 2%, you should be making about 2.5%. And again, that's 20% returns per month and 81% win rate, right? Pretty straightforward. Now, here's the thing with supply and demand is you can take multiple entries, right? So I'm going to talk about right here in a second. So this is what we're doing, right? So let's take a look at this. So let's select the bar and go back in time, right? Boom. It's coming to our zone. We're paying attention. Don't pay attention to the RSI. Doesn't matter. We're going to take one more trade. Not trade. Play button. Cool. We're in our zone. Can this be an aggressive entry? No, because there's no wick. There's no wick left. Do not reject. It's in our zone. So what happens next? We now need to take a play button and play one more candle. Boom. We leave a wick and we pass this line here. So if you remember correctly, a confirmation entry is price passing the previous wick, which it does. It did right there. Then we take that buy, right? So let's throw 10 lots on this thing. Buy, stop loss below here. And then at this point, where would my take profit be? It would not be up here. That would not be where I would look to take my profit. I would take my profit right here, right? That's where I would look to take my profit. And let's play this out. Confirm, right? Play this out. Now I'm going to show you how to take a second entry on this. This is a confirmation trade. Now, obviously, this is a replay feature, so that means the trade is kind of like going in and out, right? But you essentially take it right when it passes above. And then you play it one more time, just play it out. Let's boom, boom. All right, cool. Guess what? We have price coming back into the zone, pushing below the zone here, not all the way below here, but in the sense of like pushing in and then out, leaving a wick, and on top of that, passing above the previous wick here. Guess what? We can take a buy on this candle. So we can take another buy, right? I think I did that, and I think it put the same stop loss. Yep. So same stop loss, same everything. So I'm in this for 2 positions. So let's see what happens now. Play it out. Still in this, boom. All right, right there. At this point, I would go break even stop loss, take my stop loss to break even, right? And close half of my position, right? So I'd be up what, like, 20 for 1300, something like that, or 1200, whatever, however much I'm up. I'd close half of my position up 1200 bucks, right? And then let the rest ride. Let's see what it does. See if this thing goes all the way up or just kind of stops us out. Again, we're break even right now. We already won. We already made our money, right? We're done. Like we won. We don't need to. At this point, I don't know where we're at. We're on the beach, living our life, having a margarita. Who knows? So now it's consolidating like heck. So if it's consolidating like crazy, I'd probably just close my trade, right? And then call it a day and done and see what happens next. Let's just play it out. I don't know what it does. It's moving way too slow here for me. It's 3x. All right, it eventually goes up, which is fine, right? But that's how supply and demand works, right? So we just did a supply, we did demand, and we just looked at high probability supply and demand. Now you're probably seeing this. Well, not sure. What about this one right here? This is not a high probability one. Why? Because look, I'm just going to drag it out. You have Redwick, but it's not to Redwick, it's Redwick to Greenwick. And then, yeah, it does tap into this, but it never gives you a solid entry, right? Comes down, wicks out, and then the entries here, stop loss would be there. You would have to at least target this here. And then just reverses. This is not a high probability. If anything, it came in here, collected orders, and then just continued dropping, right? This is not a high probability one either, right? Because why? It's from Redwick to Greenwick, and then just blows right through it, right? And then right here is not a high probability supply zone, right? Reason being, because it doesn't have a lot of levels of market structure being broken, right? So now you're starting to see and have an eye out for what's a good supply zone and what's a bad supply zone, right? So again, that concludes that video. I wanted to make it super easy and simple. So now you understand this is what allows people to make money consistently, day over day, week over week, every single morning with me and my students. This is what allows us to have an 81% win rate and a 20% profit gain every single month. And again, if this is something you're wanting to learn more in detail and you want to have a done with you concierge model, no, not some guru program course or anything like that, that's a bunch of bullshit. But something that actually works, that's done with you, hand holding, step by step, every single part of the way. And me, as your coach and mentor, you essentially just come here, trade like the banks, 20% returns monthly, watch this quick video, click apply now. And this is also in the description of the YouTube video. Awesome. Cool. So I will see you in the next one. Again, my name is Nesher, the owner and founder and head mentor of FinTrade Master Academy. And if you haven't already, like, comment, and subscribe. It helps the channel grow. And I appreciate you watching this video. I'll see you in the next one. Peace.